With South Africans having no excuse not to invest offshore, it's become necessary to take an interest in which companies to invest. But a cursory look will reveal literally thousands of companies to choose from. Pieter Fourie from Sanlam Private Investments gave us his top international stock picks for 2013 towards the end of last year. And he now joins us from our Cape Town studios to tell us why. Pieter, thank you for your time. When I look through these companies, I am seeing here Johnson & Johnson, Anheuser-Busch, InBev, and McDonald's. Three heavyweights in their sectors. Is there any specific reason why you've chosen them across the three sectors? So it's consumer, it's beer here, and it's also, of course, our very favorite food, hamburgers.
Yes, I mean, I think if we take quite a long-term view on our stock picks, and if you look at the exposure you get through the consumer and the health sector, those are areas that are very much in secular growth areas, and therefore also the reason for being exposed to some of the very basic food stuff, whether it's fast foods in the case of McDonald's, and whether it's in the case of Anheuser-Busch, InBev, whether it's the beer industry. I mean, they, as is the case with Johnson & Johnson, all these companies have secular growth themes behind them, and also the businesses are very well run and they have very, very strong balance sheets. They have also, in terms of valuation levels, come off quite a bit over the last few months and certainly over the last 12 years from the very, very high levels that a stock like Johnson & Johnson and McDonald's did demand many years ago.
Pieter, these companies are so big. I mean, how can they grow? And I think I might know where you're going with this, but I'm just interested to see, you know, when you talk about growth of a company the size of Anheuser-Busch or McDonald's, I mean, how many more burger fast food outlets can they possibly build to tick that thermometer over and actually make an effect on the company's growth and bottom line?
Sure, it's a very good question. I mean, of course, McDonald's have two areas of growth. It's the same store sales growth itself, and that has been the part of the reason why the stock's been so weak lately. With 40% exposure to Europe, clearly that area of their business needs to be addressed. But we believe that being the dominant company in that space, you know, they have economies of scale that other companies might not have. So a combination of improved same-store sales growth in places, in areas like Europe, together with new store openings will give you the 8 to 10% earnings per share growth that we're looking for in an environment where, you know, my own expectations for the stock market's clearly not as high as it was 3 years ago. Ultimately, I think if you can do double-digit earnings per share and dividend growth going forward per share, then you are doing rather well. So I do agree with you. There are clearly smaller players, more nimbler players that you could perhaps invest in. But I think in this environment where, you know, some of the leading economic indicators are still quite weak, you do want to go for the best in each asset class.
Yeah. So let's move on and talk about the individual stocks themselves. So Johnson & Johnson, I mean, you talk about a difficult 2008, 2011, and I guess you're saying the company is positioned for growth going forward. Let's talk about the drivers for it. What do you see?
Sure. Well, Johnson & Johnson historically has been very, very successful with add-on acquisitions as well. And this is part of the reason why we do spend a lot of time looking at companies' balance sheets. They did quite a big acquisition of Synthesis a year or two ago. That was a multi-billion-dollar acquisition. And if you look at one part of their three business units, which is the medical equipment side, this is where they're showing very healthy growth. Combine that with on the product side for their medical drugs division, where you're now seeing some decent growth come through after a few years of very lackluster growth. I think the two combined with their consumer division now puts it on a path where it can grow at least 4 to 5% its top line over the next 3 to 4 years from a very anemic growth previously. And yet the stock on a valuation level is very similar where it was 3 or 4 years ago. And that combination to us is quite attractive when you combine it with stock buybacks and a management that's very, very focused on giving free cash flow through to shareholders over time.
Pieter, I'm just intrigued to find out why. Is it almost a case that investors have given up on the company and perhaps the promises of the previous management team? We talk about this revenue growth that was very slow for a couple of years. What's the sort of trigger? Why have investors neglected the share? And just give us a feel for what sort of valuations Johnson & Johnson trades at relative to some of its competitors.
Sure. If you look at Johnson & Johnson, the whole healthcare sector suffered from a very big derating in terms of price earnings levels from many years ago on the perception that the companies will continue to grow forever. So whereas we still avoid names like AstraZeneca and GlaxoSmithKline, who are pure drug companies, we do like the balance that a portfolio of Johnson & Johnson bring to the market. So on a forward price earnings ratio of 12, with a dividend yield approaching 4% again in a year or two from now, as I said earlier, I think if you can easily compound earnings close to 8 to 10%, and with your dividend yield, that gives shareholders double-digit earnings. I think previously, I think it was a classic case of the market wanting to see the new drugs come through. They wanted to see how the management actually integrate their big acquisitions. And now that that has been successful, of course, like it's often the case, the stock has already moved up quite a bit. It often doesn't help to wait to see until things are settled down. You have to buy on the expectation that you trust the management with a very, very good historic track record.
Yeah. So let's move on to the next one. Your other stock pick is Anheuser-Busch InBev. Now, when one looks at it, it doesn't look like, I mean, I can see clearly you are not allowing patriotism to cloud your investment thinking here, because you're not talking SAB Miller, you're talking this big American behemoth. Why?
Yes. I mean, the two, of course, you have number one and number two in the world, and both of their margins are approaching the mid-30s, which is a very, very different animals to what they were 10 years ago. I have a lot of respect for both those management teams. I just think with the acquisition of Modelo going through for ABI InBev, hopefully later this year, if you look further out towards 2014, 2015, being number one in the global beer market means your economies of scale again is superior to everybody else. And when you can buy those companies at very similar valuation levels, I just prefer Anheuser-Busch on the back of their South American exposure and the fact that they have 7 of the top 10 beer brands in the world.
Just in terms of the Anheuser-Busch, Pieter, obviously there's a couple of, quite a few geographies, I imagine, where SAB Miller and Anheuser-Busch compete. Just from the ground up, if you've done research on that, do you sort of keep track of how the two companies and others in the space are doing from a market share point of view?
Yes, I mean, absolutely. So if you look at the industry, you'll find that some of their weaker competitors like Carlsberg, who has a big exposure in Russia, and Heineken, who has a bigger exposure in Europe, even though they do trade at slightly cheaper valuation levels, they do tend to underperform as stocks in the long term, because they simply don't have the growth that these two companies show over time. And I think that's ultimately our investment style as well. If we have a choice between paying up a bit more for high quality companies that we believe will offer superior growth in the medium term, then our investment philosophy is to buy those companies instead than the one that looks cheap on face value.
Yeah, so quickly let's talk about McDonald's. We have 2 minutes to talk about the hamburger guys. Now you note here that the numbers for in the year to October were down 1.8% in October, with the US and Europe both down 2.2% and Asia down 2.4%. So where will the kicker come from?
Yes. Well, interesting enough, they've released their results very recently, and the US was actually surprising to the upside, with Asia a bit weaker again. Talking about McDonald's, if you compare to the smaller player in that market, Yum Brands, McDonald's traded at about 25 to 30% discount to Yum Brands, so we like both of them. We just think McDonald's at this stage is more of the value play within the sector, and thus our preference for that name. But of course, as the year progresses, you could well find that McDonald's might do a bit better than Yum Brands over time, as is currently the case. And at that stage, of course, as you would expect with a global equity portfolio, we have a wide choice of different companies, but they both exhibit the same trends that we like to see: good return on equities, good management teams. Again, as is the case with the brewer industry, they do have great economies of scale, so they don't have the pressures on their cost base that you would expect from some smaller players. And therefore, we do still like the stock on a 3.5% dividend yield on a price earnings ratio of about 15, which is a 5-year low for McDonald's.